Hey everyone, welcome back to the channel. Ever stared at those crazy stock market tickers? Heard about people making millions, even billions, and thought, is that even real? Could I do that? Well, prepare to have your mind blown, because today we're diving headfirst into the world of the share market. And I promise you, it's not just for the suits in skyscrapers. It's for you. Think about this. What if you could have your money working for you instead of you always working for your money? What if you could be a part owner of the companies you love, the brands you use every single day? Sounds pretty good, right? But I get it. The share market can seem like a wild, untamed beast, full of jargon, mysterious charts, and stories of epic wins and gut-wrenching losses. And let's be honest, the thought of losing your hard-earned cash can trigger some serious fear, can't it? But what if I told you that with a little knowledge, a dash of patience, and a sprinkle of smart strategy, you could turn that fear into exhilarating excitement? The excitement of seeing your money grow by thousands, tens of thousands, or even hundreds of thousands of dollars. The thrill of financial independence. The satisfaction of building a future you've always dreamed of. Intrigued? Good. Let's conquer this beast together. All right, let's cut through the noise. What is the share market, really? Imagine a massive global marketplace, but instead of fruits and veggies, we're trading tiny pieces of companies. Yes, you heard that right. When you buy a share or stock, you're literally buying a small ownership slice of a company. Think of it like this. Apple, Microsoft, Amazon, these aren't just names. They're massive empires with market capitalizations in the trillions of dollars. And when you buy their stock, you become a tiny emperor of that empire. How cool is that? Companies, big and small, go public and offer these shares to raise capital. They need money to innovate, expand, hire more brilliant minds, and, well, make even more money. And when they do well, guess who benefits? You, the shareholder. It's a win-win. We're talking about companies like Apple, generating over $380 billion in revenue annually, or Microsoft with over $200 billion. When they thrive, your investment often thrives too. Now, how are these prices decided? It's the classic dance of supply and demand. If everyone wants a piece of Apple because they just released the new iBrain implant that lets you download knowledge directly, okay, maybe not yet. The demand goes up, and so does the price of their stock. Imagine a stock that jumps 10%, 20%, or even 50% in a year. That's a massive return on your investment. If, on the other hand, a company messes up big time, people want out. Supply floods the market, and the price drops faster than a lead balloon. It's exhilarating when it goes up. And yeah, it can be a real punch to the gut when it goes down. Ever felt that rush of anticipation or that sinking feeling in your stomach? That's the market's emotional roller coaster. So, you're probably thinking, okay, I get the what, but how do I actually do it? Do I just walk into the New York Stock Exchange and yell, "Buy me some Google"? Not quite. It's where your trusty sidekick comes in, a brokerage account. Think of it as your personal gateway to the stock market. Online brokers like Charles Schwab, Fidelity, or Vanguard make it incredibly easy to open an account, deposit money, and start buying and selling shares right from your couch. No shouting required. You can start with as little as $50 or $100 to get your feet wet, or invest thousands of dollars right from the start. Now, here's a crucial point, and it's where many beginners get tripped up. Diversification. Don't put all your eggs in one basket. Imagine you only own stock in, say, Super Speedy Bicycle Delivery Co. And then suddenly, everyone starts flying drones for deliveries. Ouch. Your bicycle company's stock tanks, and so does your entire investment. That's a scary thought, right? The fear of losing 50%, 70%, or even 90% of your money. But if you're diversified, meaning you own shares in many different companies across various industries, tech, healthcare, consumer goods, energy. If one company falters, the others can pick up the slack. This drastically reduces your risk and helps you sleep better at night. It's like having a whole orchestra instead of just one violinist. Even if one musician has an off night, the symphony plays on. Many experts recommend diversifying across at least 10 to 15 different companies, or using funds that hold hundreds, even thousands of stocks. And here's the magic secret that turns small investments into huge fortunes: compounding. Albert Einstein supposedly called it the eighth wonder of the world. Imagine you invest $1,000 and it grows 10% in a year. Now you have $1,100. The next year, that $1,100 grows 10%, giving you $1,210. See how the earnings start earning their own earnings? Over years, even decades, this can turn relatively small, consistent investments into staggering amounts. If you invested just $100 a month for 30 years at an average annual return of 8%, you could accumulate over $149,000. And that is just $100 a month. If you could invest $500 a month, that figure jumps to over $745,000. We're talking potentially hundreds of thousands, even millions of dollars over a lifetime. Just think about that possibility. The sheer excitement of seeing your money multiply without you lifting a finger. So, where do you start? Don't feel like you need to pick the next Apple. For beginners, exchange-traded funds, ETFs, and mutual funds are fantastic. These are essentially baskets of many different stocks, professionally managed, giving you instant diversification without having to research hundreds of companies yourself. It's like buying a pre-made investment pizza with all the toppings. Some of the largest ETFs hold over 500 different companies and have generated. Here's the truth. Market crashes will happen. They always have, and they always will. The truly successful investors aren't the ones who predict every peak and valley. That's impossible. They're the ones who stay calm, stick to their long-term plan, and often see downturns as opportunities to buy more at a discount. Remember, great companies tend to recover. Think about the dot-com bubble, where the Nasdaq dropped over 75%, or the 2008 financial crisis, where the S&P 500 fell over 50%. Those who stayed invested, those who kept buying, ended up significantly wealthier when the markets recovered, sometimes generating returns of 100% or more from the lows. Investing is a marathon, not a sprint. Don't chase quick riches. Don't get caught up in the hype. Do your research. Understand why you're investing in a particular company or fund, and then be patient. Let compounding work its magic. It's not about being a genius. It's about being consistent and disciplined. But your journey is just beginning. There's so much more to learn, and I'm here to guide you every step of the way. If you found this helpful and you're ready to unlock your financial potential, do me a huge favor. Smash that like button. Share this with anyone who needs to hear it, and most importantly, subscribe to the channel and hit that notification bell so you don't miss out on our next deep dive into making your money work harder for you. Your future self will thank you for it. See you in the next video. See you in the next game-changing video.